They get used to big ranges, right? They get used to a Bitcoin pump being $2,000 price change, rather than right now where Bitcoin's entire price change is just minuscule in comparison, right? This is like this entire big squeeze move was only 1,000, 61.8 to 63.2. It's about $1,400, and in percentage terms, which is more relevant and accurate, 2% move. 2% move right now is fucking huge because we're in this low volatility phase. But back over here, when it was going up 5k every week, a 2% move was nothing. Absolutely nothing. These are 15-minute candles. Look at this. This move happened in like the space of 3 hours. 3.7%. 4% basically. This dump. 8% in a matter of minutes. Then even just a reaction bounce. Just a tiny little bounce in the range, right? Not a big trending move. Just a regular old move. Was 4.7%. That's just a little bounce. This volatility is beautiful. It makes me so happy to see it. And it makes me so angry that it's gone. Most people just don't understand volatility. Instead of waiting for proper volatile markets, where you can just long a super basic little bounce, doesn't take any lows, doesn't take any highs, just a mean reversion, right? Refilling a bit of the inefficiency. 4.7%. That's such a volatile move for Bitcoin. Compared to now, where you just have, like, this is the equivalent move here, right? Where it broke down into a level, it bounced up a bit. That's really all, that one I just showed you. All it really did was, it went from the lows of a retest up until not even the highs. Just filled a bit of inefficiency, right? Now look at the equivalent. That was 4.7%. Now we're scrapping around looking for 1% moves. Does this make sense in the chat? Do you understand what I'm trying to explain with the idea of volatility? Because I say volatility a lot. People talk about it a lot, right? Volatility is everything. It's everything. Right? And so what most people look at and think is, but wait a minute, like, if price action is still price action, then why is this retest up to here? Like, why is this move not just as valid? If I enter there, right? If I enter there and I put my stop loss below the low and I trade it up to there, that's 3.64 R. So in R terms, it doesn't matter, right? Compared to, where was this move? All the way over here. Compared to this move over here, which was this one, where I could get long, at these lows, put my stop below that wick, and target up to this level. Still 3R. How is this one better than the other one? Because volatility is what you need as a trader. If you have these big wide-ranging moves, you can capture much more of them with lower leverage, lower position size, so lower fees, and with more actual trend support. Because when something's volatile, there's more activity, there's more people trading. It might look okay in theory here. Oh, but that's still like 3.3R is 3.6R. But that's in theory. The problem is you have to dial up the leverage because you have to use a higher position size. To use the same amount of risk on a 1% move as you use on a 4% move, all else being equal, you have to use 4 times the position size. So that's 4 times as much fees as well, in and out. And that really adds up for a day trader. And it's mostly day traders who get affected by low volatility. So if you're having to trade 4 times as big, like, again, Let's double fucking stamp this. Let's really hammer this point home. Because we're looking at this, whatever, 3.7 hour trade, right? But if I wanted to risk $1,000 on this trade, the stop loss is 160, right? So that's roughly 7 BTC, roughly, would be the position size. 7 times 160 is just over 1,000. So it's actually 6 point whatever, but you get the idea. That's a 7 BTC fee to pay to enter, 7 BTC fee to pay to exit. And then the slippage on those as well. Because in low volatility markets, you tend to have worse slippage. Now, you have potentially worse slippage. Because when the low volatility disappears and you get a sudden burst of high volatility, that's when you get really bad slippage. Low volatility is less liquid. Because less people trade it. Because there's less people trading, it's self-perpetuating. Now let's go over here. Look at this one. You just enter there. Right? Stop loss below the low. Whatever. I'll make them both like 3 hour trades. Or 3.7, whatever. Same exact trade idea, except a more volatile move. In this one, to risk 1,000, I only have to put on about 1.9 BTC. And that's the big difference. Why? Because it's $579 of a stop loss. So about 1.9 Bitcoin would be about 1,000. So it's 1.9 BTC. And so let's look at that. Your fees at that 60k level at 1.9, the fee to get in would be 1.9 times 60. I'm just roughly using 60. Times 0.055. I'm just using the standard Bybit percentage. Is $62 in, $62 out. So your total fees, not including slippage, would be about 135. Right? So that's just the amount you pay to play on that trade. Okay? That's taking Bybit's standard market order fee. So you mark it in, mark it out. Assuming you hit a stop loss, you pay $135 before you take any action on that trade, right? Good, makes sense. Let me make sure I've got that right, because that actually seems quite high. But let me just double check. 60,000 times 1.9. So 114,000 position size times 0.055%. Yeah, that is correct. 135 fees, right? Let's go over here. Imagine you're trading it now. This is now 61.9, so 61.9 times 7 times 0.055%. This is, and you're going to be shocked here, some of you. Well, hopefully not. You're blue belts. You should know this roughly. 238 each way. Right? So that's 480, give or take $1 or $2, fees. So by trading the smaller range, you have to use the bigger position size, and you pay $480 for fees versus, where the fuck are we? All the way over here. 135. Right? So what's that? Like triple? You're paying triple the fees. So not only is it moving less, which by definition will give you fewer setups, because there's no trader who has a system that works better in low volatility environments. Yeah, Felfeld, like it says, your winners are chipped down. On paper, you scalp a 7R, correct. But with fees, it can easily be cut in half. Like that one, that second one, that was almost $500 in fees. And you're only trying to risk 1,000. So you'd lose 1,500. And so to counteract that, you have to use a way smaller position size, which then limits your profitability on the upside. The easyology. So this is why trading in bear markets is fucked. Correct. Because the bear market in general has low volatility. Like these conditions we're in now and have been all week, right? So basically since last Tuesday for this last week, this, if you've not been through a bear market, this is what a bear market is like for a year. And in between, whereas in the bull market, we had 6 months of high volatility. This was all nice and volatile, bit of compression, but then volatility again, even a nice volatile range, then a nice sell-off, then a nice recovery. So nice wide-ranging, either up only or volatile moves. And even at the top here, nice volatility there. And then since the 13th of April, when we had that crash down, volatility's dead. And it's been dead now for about 2 weeks. So this 2-week period is the exception, not the rule, in a bull market. So that 2-week period will go away. We might have, like I said, I think we maybe have another 2 weeks, maybe another month, whatever. But that's like 5-6 months of good volatile trading conditions, followed by a couple months of bad conditions, low volatility, and then back to high volatility again. That's generally how it goes. But the inverse is true in a bear market. Most of the time, you have shitty conditions, and then a little bit of the time you have good conditions. But often, by the time you notice the volatility's back, you've missed most of it. That's why it's so hard as well. Akos, GM. Very interesting question today. The point is that you've told me on my first day on this campus that I need X and Y amount of money to start trading full time. Since I got a healthy amount of raise in work and also a good amount of money saved from last year, I will have the money to support myself for a year and the money to trade with by September, October. I don't know if you remember my old big gold note, but I for sure want to leave this place in the whole industry. All this sounds good, but I really don't have a plan yet. It's better to discuss it now than worry later. Is there any advice you give me for getting into this case? I'm not really scared or don't doubt myself. I feel like it's be failed, but there's still a bit of pressure that I have this one chance. Well, you don't have one chance. That's the thing, right? You don't just have one chance. You shouldn't put yourself into a position where you only have one chance either. But what is good is to, if you're going to give it a go, that you do set a time frame on it. I was talking with one of my students in DMs about this exact topic of, I'm going full time, and I sort of have this doubt, as you naturally would, because you're actually going sort of all in. You're like, all right, this is it now. And I'm a little bit fearful because the path is unknown. And so my answer to that is, the reason why you're kind of nervous about going full time is because in your brain you're thinking, this is all I'm ever going to do, right? And it's like, if I can't be a profitable trader forever, then it's a waste of time to ever even do it. So your brain thinks in extremes, all or nothing, but that's not it at all. If you decide to go full time and you say, I've got 1 year of living expenses and I've got my money saved up to trade full time, there's your time frame. You're like, I am not going to think about the future. I'm just going to think about the next year, and I'm going to do everything I can do in my power every single day with my analysis, with my plan, with my action, with my back testing, forward testing, etc. I'm going to do everything in my power for the next year. And if I haven't made significant progress by the end of that year, I will know, and then I will stop trading. Now, that is not the same as saying, if I don't make 100x, or if I don't triple my portfolio, or if I don't grow my 50k into 150, then I quit. No, it's, I'm going to do everything in my power for 1 year, because that's how much I've saved up, right? And I'm willing to take that sacrifice that year to give it a go, because if I get it right, and I can be a trader for the rest of my life, it's the most beautiful existence ever, right? So I'm going to give it a go for that year. And if I can't seriously sit down and say to myself a year from now, I have significantly progressed, then I know it's not for me. That's all you need to do. Laddie, GM, are you a blue belt? I guess you are. Sometimes this thing's a bit frozen. GM, you mentioned in many of your lessons the point of building a big trading pot is to not touch it, so it consistently grows over a long period of time, which is the complete antithesis of most wannabe professional traders who expect a regular clocked-in income once they become a pro. Correct. Perhaps one could argue that the perfect balanced solution between the two extremes would be a system which takes some minimal profit as a rule after hitting certain milestones. For example, 2.5k take-home profit after reaching 30 or 40k milestone. This way, one would ensure that even if they blow up their entire portfolio or suffer very significant drawdown at high levels, they would have to take consistent profits along the way. What do you think? Yeah, well, it's not really the same thing though. Like, I don't think what you're saying is contradictory to what I'm saying. The thing I'm saying is that you should not aim to touch it, to live off. That's different to saying, you know, I've got 100k trading balance and I've grown it to 150, but I don't want to keep all that 150 on the exchange or in the wallets I don't want to have it at risk in any way. Or, like you said, I don't want to have it so that if I do have a big lapse of judgment and my emotions go away, I don't want to be able to easily deposit that money and be able to lose it if I start gambling. So absolutely, like pulling some out and putting it away on the side, even if you intend not to sell it or use it, that's totally fine. Yeah. Putting it away, having it off, put it into something else, even put it into fiat, right? Put it into actual cash, because then it's harder to get it back onto an exchange to lose it. Because the only way really you can blow up is through poor psychological control of yourself. Schrodey, GM, thank you for the kind words with the injury. I'm so close to 100 blue belt trades, 87 in with 8.4 EV, very good. Started trading at the beginning, risk 20 cents. Quickly realized 20 cents risk not often possible to set the correct position size. I have 16 trade, put more money in test count trade 50 cents risk, which works fine so far. Do all 100 trades if they trade at the same risk? No. As long as you've said on each trade what your expected loss versus realized loss was, then that's totally fine. And I love this profile picture. It might be my favorite Apu, doing his weighted pull-ups. Stargazing, GM. I recently started live trading with my breakout system on 30-minute charts. I have a question regarding risk and deviation context. I decided that I wanted to risk 50 cents per trade. In my first 3 trades on a certain altcoin, the expected risk at the time of me entering the market was roughly 45 cents. Problem I'm facing right now is the price changes made me unable to achieve expected loss within reasonable limits. As the minimum position size is 0.1, I can only enter a trade with expected loss of 30 or 60, both of which should reach. Yeah, I covered this in I think I covered it in the FAQ lesson, if you want to check it out. That's totally fine. Like I said before, as long as you say your expected risk and your actual risk per trade, and you're accurate with that, that's fine. If you risk 30 cents on one trade and you lose 33, good. If you risk 70 cents on the next trade because of position sizing constraints and you lose 75 cents, good. It's still within 10%. So that's fine. Arthur, GM. Dollar trading, I'm close to completing 60 trades so far. 7 consecutive losses twice. This loss really fucked my mind, made me feel like my system isn't working. Yeah. So, very, very common. When you have a loss streak, this is why it's so important. This goes right back to what I said at the start of the stream. Can you imagine how destructive that would be if you were trading full size? If you had a 10k portfolio and you said, fuck Michael, I'm not going to do dollar trading. I've backtested this system. It works good. Let's go 1% risk, $100 per trade. And then you had those 7 losses twice. Because you can see how much it affects you, even with dollar trading, which on paper is meaningless. $1 doesn't matter. You've lost $7. Oh no. But because it's trading and you waited for them and you set the trades up and you took them, it does play with your mind, especially the first few times. So you've done exactly what you're supposed to do. Learn cheap. This is the perfect advertisement for dollar trade. This is exactly why we do this. Why Blue Belt exists. So you've done the best thing possible. And what's important now is you keep trading. You keep going. Like you say, shut the fuck up. Stick to your system. Exactly. Because all you need now is to go and have a few wins again. It's not the loss streak that gives you the fear. It's the thought of never winning again or not being consistently profitable again. So when you have the 7 losses and then you start having a few wins, you're like, oh, wow, I had 7 losses, but then I bounced back. Then it happens again. Now you need to just keep going. Don't quit. Don't switch to another system. Because you have to prove that you can trade through that. And once you get back to just, 2 or 3 wins, 1 loss, 2 or 3 wins, couple losses, and back to normal, you're like, oh, wow. There is no order to this, right? There's no such thing as a streak. It doesn't matter if I lose 7. Over 100 trades, the outcomes are going to be distributed randomly. Dasher, how to deal with the thing that your brain wants to build a system on the 1 hour time frame, you take more trades, pass blue belt, more pro belt fast, but as you teach in this game, we should be snipers and not take a lot more trades. I do understand. You just have to do it, bro. Like, again, it's up to you. Even though in one side it can be a negative to do what you're doing or what you're thinking about doing. Wow, so many questions here. I'll have to go quicker. I need to finish. You need to just trade to your own plan. You could take more trades. If you're ever going to do that, right? If you're ever going to take, as long as they're systematic, not gambling, not just fucking YOLO, but trading a lower time frame. If you're ever going to do it in blue belt. Dollar trading. That's the point. Like I say, this is the time you test things. You try out day trading or swing or position. So you can absolutely do it now. Or if you think, no, that would constitute impatience and I want to build patience, so I'm going to stick to my higher time frame system that's tested. Klaus, how can we tweak and add indicators for systems like 1221, KC, RSI, and so on? It feels subjective every time. Yeah, it is. It's subjective to pick one. But then you make a rule and you test it, and then it becomes objective. So if you have a system and you say, I'm going to add RSI to it, that's totally subjective. You have no data to prove that RSI is a good indicator to add to your system. But what you do say is, I'm going to add bullish divergence on the RSI to my 1 hour, whatever, mean reversion system. And then you go and test it. And then from there, that's what's going to give you more confidence. X Magnifico. In live trading, do I need to record a screenshot of my trades? True swing trade, no idea to present all trades. Yeah, go and watch the last two lessons. If you're doing the 30 trade path, you do. So this is all in blue belt. If you go to the final submission alternative, I have a video on it where I go over it. Here, you can watch that video. That'll explain exactly how to do it. Woofy. System, retested my submitted system more accurate. Find it when it is 4 hour, the win rate is 31%. When it's 2.5 hour, the win rate is much bigger. So the question is, better to have a better win rate with lower hour, bigger hour. Expected value, bro. That's all that matters. That's what EV is. So go to the expected value lesson. Is it better to have a high win rate, low risk reward, or low win rate, high risk reward? Or any of the above, or any of the in between, or any combination? The answer is all of them and none of them. Because the only way you're going to know is through EV. So you have to find the expected value. That's absolutely the most important thing. Expected value. As my alert goes off. Bitcoin. Yeah. Bitcoin much weaker here than Ethereum. Well, in one sense, Bitcoin's just more volatile today. What are the key elements to build a successful scalp strategy? Maybe more momentum liquidity systems and made premium discount range trading system for scalps with relative low EV. The question is, what are the key elements of scalps? So a scalp is a momentum trade, right? In a really simple sense, with a scalp trade, you're trying to predict the next few minutes. And actually, what you're trying to say is, like, for example, Bitcoin here, you're saying that based on my systems that have been tested, the 5-minute bands have gone red, it's in a downtrend in this channel, it's about to lose these moving averages, and it's about to go into a gap. And the gap goes all the way down to this previous support. So the momentum trade, the scalp, is not to get, you don't get short here. You couldn't get short here on a scalp. I mean, you could technically do anything. But when there's a wick there above it, you'd be looking at this and saying, okay, with everything I just lined out, which I just made all that up, right? But with everything I've just laid out, if Bitcoin is not able to hold this wick, then it's going to fill in all of this because of all of the above. So you would not short it now. You would short something like a 1 minute high volume breakout below this level, which we're actually about to get, right? So there's a high volume 1 minute candle. If this closes below that wick, I would trade it as a momentum play. Now it's battling to try and stay above that wick, but let's see how it closes in 20 seconds. There it goes. It's breaking down. The idea would be, if that's Bitcoin losing this level, it could go all the way. And that momentum is solid. Now we have to wait and see. Is it going to reverse? Is it going to hold? Whatever. Because, if you don't stick to some rule, then what are you doing? And there we see it's reversing back up. And it closed back inside. Just about. So no trade. Because you're trying to catch the momentum. Right? Now this fight might very well go down. And of course it is looking weak, and I think Bitcoin goes lower. But you're trying to capture momentum. So it has to be, the idea of a scalp is a move that goes in one direction and does not come back. Because all you have to do, if you want to understand what a scalp looks like, it's any one of these moves that goes one direction. It was this break here. Right? Let me take off all this stuff. A correct scalp, right? Let me show you two trades. On one trade, you short here, or let's say on one trade you short this bounce, right? You short here and you put your stop loss above the highs. That to me is not a scalp. First of all, you're going against direction. You're shorting into a bounce in a downtrend. So you're probably entering with the limit order. You'll very rarely ever enter a scalp with a limit order. A scalp is this, right? Bitcoin moved up with inefficiency. There's liquidity below, right? So it moved up with an inefficient move. And so when Bitcoin's up here, you're like, okay, it moved up, inefficient move, stops below, let's target those stops. It consolidates sideways, it breaks structure. So you're allowing all this to happen, right? It had a market structure break here in the 1 minute. It had a failed bounce there. It come over here, it consolidates, it tries to hold, it holds. Breaks. The perfect scalp is getting in there and riding the momentum all the way down, where it almost just goes straight to your target and then you're out. That's a perfect scalp. And it doesn't matter how you arrive at that. It's not about market structure. It's not about indicators, EMAs, or any of that. They're all just tools. The key difference between a scalp and a day trade is the amount of time you plan to be in the position, right? If you went short, if you shorted Bitcoin up here as a day trade, and you shorted it there, or let's say you shorted this breakdown, right? And you shorted on that bounce, and you put your stop with a bit of room above the high. Let's just imagine you didn't get stopped out. This is a day trade, because you're still sitting in it and price isn't moving, right? It came down a bit, then up a bit, you didn't get stopped out, you sideways and down. If you're sitting in the trade for 3-4 hours and it's